Good afternoon, ladies and gentlemen, and thank you for joining us for the end of October Investment Committee update. This month, as usual, I'm joined by Michael Reynolds, who is an Investment Committee member and Director of FMD. And we have our special guest, Jeremy McPhail, Head of Professional Standards, who's standing in for Richard Dahl this month. Jeremy, I think this is the second investment update you've done for us, so thank you very much. Thanks very much for joining us today. And Jeremy, since you're new and newly in the hot seat, I thought I'd start with you. If we look back over the last 12 months, it's really been a tale of two halves from an investment perspective, hasn't it?
Correct. Yeah, definitely. Yeah, so certainly up until March this year, things were looking rosy. Markets were performing very well, and looking at the glass half full, and certainly looking for positive aspects for what was tracking along, and that economies were performing relatively robustly. Since that time, I think the blip on the radar at that point in time was the regional banks in the US. There was a question mark as to whether interest rate rises in the US had gone too far and caused some friction in that part of the world. Fast forward another 6 months, and there's been further rate rises, and then obviously more recently the geopolitical tensions, unfortunately, that have caused a bit of ruction in markets, which is something that we've had to confront.
Yeah, so a really positive start, but a bit tougher more recently, and some contrasting things. Mike, following that last week on race day, the Reserve Bank governor announced her first rate rise. How did you see it?
Well, I was disappointed, but probably not unexpected. The economic data showed our economy was still strong. Wage pressures, we get some wage data tomorrow here in Australia, but the data has been arguably somewhat supportive of an interest rate rise. We've seen cash rates move to 4.35. Interestingly, the behaviour in the market for the bond market was, went against probably the interest rate rise, because both 10-year bonds, 5-year bonds and 2-year bonds all traded with lower yields, which is good from a bond investment point of view. And that is sort of a reflection of the uncertainty of the market about how much further interest rates have got to go. There is two sides of the fence. One thinks they've done enough, and that central banks should be patient and see the flow-on effects of the interest rate rises we've preceded early in the year. The US Fed stopped raising rates for the last 2 months. And so that's the challenge for all the investment markets, is the uncertainty. We've talked about this all year. Beginning of the year, I said we should be finished by April, and by April, I said it'd probably finish by September. Now, when we're in November, I think it's probably got another 3 or 6 months to go. So that's the challenge.
We're sitting here. The central banks are balancing these challenges. What's the FMD Investment Committee doing, Mike, thinking about those things?
Well, we've broadly held our nerve for most asset classes. Early in September, we made a decision to reduce our equity exposure marginally and replace that with an increase to bonds. That was primarily done on the basis that interest rates are now at a more attractive level, where you actually start to get paid some reasonable income for defensive assets, which has been the Achilles heel of most investment portfolios over the last couple of years. Because when interest rates were zero, you weren't getting any return at all from defensive assets. And so we've made a decision that bond rates are now attractive, and they should also act as a defensive mechanism if equity markets do get messy at some point in the cycle. Typically bonds are inversely correlated to the share market. So when the share market falls, bond values tend to rise, and conversely, when equity markets do really well, bond markets tend to do not so well. So we're at the point where we think there is some value, and that's why we've made that change.
And Jeremy, I think it's fair to say that if you looked at the historic data, or the last couple of years' data around bonds, it's a bit of a bold call to increase bond exposure. But what would you say to that?
I don't think it's so much a bold call. It's your starting yield that really matters with these sorts of assets. And as we saw through the last couple of years, starting yields of 1 or less than 1%, you have challenged returns, and that led to some capital losses on those sorts of assets. Today, if you looked at the rearview mirror for making your decisions for where you allocate your capital, you'd avoid that asset class. It looks pretty ugly. But today, with what Mike just suggested, interest rates are much higher. Central banks have done a lot of the heavy lifting. Markets have adjusted to those sorts of yields as well. So a 4% plus yield from a defensive asset is a much more attractive and appealing proposition today. And you've got to look forward. That's the indicative yield of what you'll generate from those assets going forward. Notwithstanding, there'll be a little bit of capital volatility, but you would think that that's a much better proposition today than starting at 1.
Yeah, and I think it's the old adage about not investing looking in the rearview mirror.
100%. Yeah.
And can you talk us through the investment quilt? That's something that our advisors occasionally use with clients. Can you give us a little bit of a summary of how that works and the intention of that?
Yeah, so thank you. That tries to graphically demonstrate the returns from different asset classes over the longer term, and it just shows how difficult it is to pick a winner from year to year. Hence the adage that diversification is one of the free lunches that you get in investing, that you want to have a breadth of exposure across a range of different asset classes to ensure that you're not holding the worst, but it's hard to know what that might be. You want to obviously try and hold the best, but that's hard to pick as well. And so because it is difficult to pick next year's winner, one of the best strategies is ensuring that you've got diversification. And you can see within the quilt that there's different ranges of returns for different types of asset classes as well. As we know, the fixed interest journey more recently has been more challenged. There's been periods of time when equities or real estate has been challenged, listed real estate. So every asset class has its day in the sun. It's hard to predict what that will be and when that will be, but certainly diversification is, I suppose, the key message that comes out from that graphic.
Yeah, and as the ad says, past performance is no indication.
100%, and that couldn't be more true in fixed interest today.
Yeah, that's right. Well, thanks for that, Jeremy. Hey, we might just move on and have a little bit of a think about some other issues that are happening in the market. One of the local things that has been discussed is the fear of a mortgage cliff. Mike, what do you think of the mortgage cliff? Is that a real issue at the moment? What do you think about that?
I think it's an issue for those people that have got fixed rate mortgages that are about to go to variable, because the cash flow impost on those families is going to be quite significant. Interestingly, with the mortgage cliff as per se, normally, a significant rise in interest rates where we've been would normally see a lot of pressure on house prices. We just haven't seen that occurrence, and it's really a reflection of a lack of supply of housing in the marketplace, strong immigration, and a big return from foreign students, which have soaked up a lot of the vacancies that we had during the period of COVID. So I think house prices and the effect of the return to more normal interest rates. And I think got to remind people, when interest rates were 1 or 2%, that was not normal. If we look back through the history of where mortgage rates have been priced in Australia, we're at a much more normal level today, sort of 6.5%. So as long as central banks don't push things too hard from here, I think our economy will cope with that. I think those people that have borrowed excessive amounts to get into the property market and had done their budgeting on interest rates being 3% forever are in for a rude shock. And that's part of the adjustment process. But central banks are very much aware of that circumstances, and they don't want to blow the economy up by making, over aggressive interest rate policy. So I think we'll muddle through this. But clearly it is a challenging time. And, interestingly, there's some data in the paper today. The average mortgage in Australia is just under $600,000. And at 6%, as a mortgage rate. There's $36,000 a year, $3,000 a month as an interest cost after tax in many cases. So it is a challenge, and for another day conversation was the ability for people to get into the housing markets becoming increasingly difficult. So
this might be something we can pick up a bit later in the year, Mike, I think. Yeah.
Absolutely. Yep.
Yeah. Jeremy, obviously, 18 months ago or so, we saw the escalation of the war in Ukraine, and more recently in the Middle East. Yep. Geopolitically, what do you think the issues are that we need to be monitoring at the moment?
That's a good question. There's still other tensions out there which clearly need to be not resolved, but hopefully kicked down the road a bit. There's hopefully the policymakers start to keep the pressure in the right directions in the Middle East, and things don't get too further escalated from where they are today. You can see there's a lot of talk at the moment trying to de-escalate things and trying to ensure that there's resolution and clarification around when things do come to a conclusion there, similar to the Russia-Ukraine situation as well, that it's hard to know what the conclusion is to some of those tensions that arise. It's a challenging world in that respect. And again, coming back to some of the investment fundamentals, it's why you need diversification in your portfolios. So, yes, these unfortunate events do arise, and we hope that there's political wherewithal to ensure that there is reasonable outcomes for all parties involved. And it's a very difficult statement probably to land, because there's so many different angles and so much history, I suppose, involved in some of that as well. But from an investor's perspective, we need to expect that these sorts of things will arise. Yeah. And it's challenging to know what the direction will be or what impact those things will have on markets. I think the recent issues in the Middle East, you would have expected that there would have been tension in oil prices and energy markets, and that didn't come through. The energy market here, the global energy market's now a different place today than what it was, say, a decade or 15, 20 years ago, where the US is a large supplier. So it's hard to pick specific things that will arise that will cause issue in portfolios. Again, as I come back to, that's why diversification really matters.
Mike, is there anything you'd add to that?
I think broadly markets have taken both the conflict in Europe and the Middle East conflict in its stride, as much as that is a bit of a poor reflection on Western society, capitalism a little bit. But I mean, markets haven't really been affected by it. I think the challenge is if the conflict in the Middle East expands, which we hope it doesn't, that could have a significant effect on markets. It hasn't thus far, and I think if the conflict is contained within the proximity of where things are, I don't think markets will be affected, and it just reinforces that interest rate policy of central banks have been really the only thing that has been driving market behaviour over the last 24 months. We had some short-term movements in markets when Russia first invaded the Ukraine, but broadly markets have been dismissive of those actions. So we haven't changed anything strategically within the investment portfolio as a reflection of those conflicts, and assuming that things don't expand from here, we wouldn't really move to make any changes, I don't think.
Great. All right. Well, thank you, Mike. Thank you, Jeremy. If I summarise what I've heard out of that to some extent, is that the key thing we're still monitoring is the central banks and their attitude to rates.
Absolutely.
And that's impacting all over the economy, from equities and bonds. And we continue to monitor the progress there, hoping for a relatively smooth return to more normal inflation rates. And Jeremy, as you said, that diversification remains absolutely critical, and that's one of the things that the Investment Committee continues to focus on. So, Mike, thank you very much for joining us today. Jeremy, thank you for standing in for Richard. Much appreciated.
Thanks, Lee.
And look forward to doing this again soon. Thank you.
Talk soon. Thank you.